Hi again, I'm David Maurice, fee-only certified financial planner for Worthwhile Wealth Counsel.
And I'm Andrew Worley, Associate Advisor here at Worthwhile Wealth Counsel. So David, I'd like to share something with our viewers this week.
Okay.
Last week when I was running our weekly funds report, I saw numbers in a particular area that I couldn't believe and assumed they had to be a mistake. Yet when I ran the review again this week, I saw those same numbers in that same area and was shocked to find out that they're accurate. Do you know what I'm talking about?
I certainly do, Andrew. I too was shocked, and I still am. In all my 30 years, I have never seen that data set, those kinds of numbers. You're talking about the 1 year trailing return for the U.S. equities, and they're in the 80s, 90s, and 100%. That's amazing. And the thing is that the reason I saw that is because I had a client review just before those numbers came out, saw it in their performance report. So I'm telling you, that was one really fun review.
I'm sure it was.
It was.
So if we go back a year ago from this week, what we saw was the arrival of COVID.
Right.
Stock market went off a cliff.
Yep.
Businesses were closing down. Essentially, the economy was closing down.
It's true.
And ultimately, some businesses would go out of business.
Absolutely.
Yet from that point last year to today, we're seeing one of the strongest returns of all time.
Strongest recoveries. I agree, Andrew. And the value of this is to preserve those numbers for that 1 year return in our minds for the next disaster that comes along, when the media is telling us the world is over, it's doomsday, to remember in our minds what it felt like in 2020 and still had this monstrous recovery.
So if we go back and look from last year, what did the worst last year has now done the best, it's healed and is outshining the rest of them.
That's true.
So before we finish our video today, let's cover what we saw in our funds last week.
Okay.
So last week, all U.S. equities were down except for healthcare, with small caps falling the most, with value down almost 3%.
I know, but you know that 3% down for small value, even though it's that much, it's still at 24% year to date, and that is 10% ahead of all of its competitors.
Well, out of all U.S. equities, large growth is still the only one that's negative year to date, but all growth is having to move over to let small companies have their time in the spotlight.
That's true, small and value. You know, last year it was small companies that did the worst and stayed down the longest, and you had large growth ending actually right about 40% for the end of the year. So we have watched that seesaw with large growth here, Andrew, and small value here, just completely trade places.
So to finish up our report, foreign companies, except for emerging markets, were all up last week. The only thing that remained in negative so far still is foreign growth.
Well, that's not the end of our report. What about bonds?
Well, our bonds are bewildered. They forgot what they were supposed to do. So for this week, let's just let them sleep.
Okay, well, you know, all this is just so fascinating for us nerds to watch these things move in and out like that.
Yes, and nerds we are. Well, that's it for this week. And as always, I'm Picky.
And I'm Petty.
And we're the
Picky Pedants of Worthwhile Wealth Counsel.